Thanks everyone for joining us for our next Ripple Ventures Tank Talk with Fabrice Grinda to discuss investing in marketplaces before it's a marketplace. Thanks for joining us in the tank today, Fabrice.
Thank you for having me.
Now, just a brief background on Fabrice. As I mentioned, he is the founding partner of FJ Labs, which is a stage-agnostic, New York-based investment firm focusing on marketplaces and consumer-facing startups. Prior to that, he was the co-CEO of OLX, where he started the company as the Craigslist alternative for the rest of the world outside of the US, with over 200 million unique visitors per month. Prior to that, he was the founder and CEO of Zingy, which is one of the largest wireless media companies in the Americas, which he grew to over 200 million in sales in 4 years. And before that, he started Aucland at the age of 23, which grew into one of the largest auction sites in Europe. On the angel side, Fabrice has over 300 million in exits and over 150 exits as an angel and over 500 investments, and is an impressive track record as an early investor in Alibaba, Lending Club, Delivery Hero, and Brightroll. Let's start things off with your operator journey, Fabrice. So in 2001, you started Zingy and grew it into one of the largest media companies in Americas, and eventually sold it to Japanese mobile content powerhouse Forside.com in 2004. What lessons did you learn from the explosive growth you experienced at Zingy that you still live by today?
Well, it's funny because it's true that in hindsight, it was explosive growth. It was a million in revenues in 02, 5 in 03, 15 in 04, 200 in 05. But frankly, the first 2 years were so rough. It really didn't feel that way, right? Like the first 2 years, the internet bubble had burst. It was like the nuclear winter of the web, where it was impossible to raise any VC money. I'd invest every last dollar I had in the company. I borrowed 100,000 of my credit cards. I mean, we missed payroll 27 times. It was really a case of grabbing victory from the jaws of defeat, where the way I funded the company ultimately was through profitability. So actually reaching profitability, becoming the master of our own destiny. And then later, as we became profitable and started growing really rapidly, I think it was, I'm not sure what the key lessons there, success factors. It's really scaling in line with the band we had. So I only hired, when it started hurting. And yes, we went from like 7 people in August 15 of 2003 to like 200 like a year and a half later. But at the same time, revenues went from essentially nothing, 200 million a year in revenues in that time period. Moved offices 5 or 6 times. I'm not sure they're like fundamental life lessons to be had. I think but probably the stronger lessons were in the early part, where I was working day and night, sleeping on the couch at the office. I couldn't even afford food. I was like eating ramen noodle and couldn't afford coffee, let's say, and had the staying power and grit and tenacity to ultimately make it on the other side.
So it sounded like you loved living on the far end over your skis the entire time, and you were just growing seriously fast every single day. But maybe did you think about maybe taking a pause and thinking about building the structure, the infrastructure around the company early on, or did you just have no time to even think about that? And from that experience, are you now looking at companies differently when they're way over their skis and don't even look in the backseat to see if everything's buckled in okay?
Well, you always need to think through objectively, are you in the right business? Are the economics of the business you're in attractive? Are you doing the right thing? So I think it's very important as a founder to be super deliberate before you launch about is the category attractive? Does it have the right unit economics? And when I'm doing my testing, am I not just doing confirmation bias because I'm interested or I like it or I want to do it, but actually verifying and validating the idea is objectively valid? Because the thing is, as a founder, the only thing you have to invest is your time. And so you don't have many at-bats. And the 5-year survival rate of a startup is only 7%. And so actually being thoughtful and deliberate, and it took me a fair amount of time. I mean, I left Auckland, I think, in October of 2000, and I launched this company in July of 2001. So I took 9 months of deliberation, testing, ideation for this. But once you pull the trigger, it's all execution. Even though you try to do it in a thoughtful way, meaning hire the right people at the right times. We eventually had a full team, but you don't want to start with a full team. You want to have the right person at the right time in the life stage of the company.
Prior to Zingy and prior to starting OLX was the company you mentioned, Auckland, which was really originally named Alibaba, is what I read, but you couldn't buy the domain name, and so you basically had an agency come up with Auctionland or Auckland.
That's exactly it.
It's an amazing story, and we'll save that for another podcast. But you originally offered the technology to Alec Oxenford, who used it to build Dermate, which he eventually sold in 2006. And as fate would have it, after Zingy, you reconnected with Alec to start OLX in 2006 as the Craigslist for the rest of the world, and eventually had a successful exit to Naspers in 2012. After so many twists and turns through the OLX journey, what lessons did you learn about relationships and deal making that you still rely on today?
Well, many things. First of all, life is long, right? So treat people extremely well, right? Like Alec is someone I met in '99, and in fact, as part of that co-founding team of Denemate, there were like a number of co-founders. So they were numerous. One of them was Jose Maria, who ultimately became my co-founder in FJ Labs. And so the relationships that you build can last a lifetime, and even if you don't think you'll reconnect with people, you often do. So life is a marathon, not a sprint. So definitely optimize for the long run, and just be good and honest, and people will respond in kind for the most part. And what's interesting is if I look through the companies over time, basically I've kept the very best people along for the journey. So my CFO of Zingy became my CFO at OLX. My chief marketing officer at Auckland became my chief marketing officer at OLX as well, and then now as a venture partner at FJ Labs. So over time, you can actually build these very deep, meaningful relationships. And the same is true not just professionally, it's also true personally. And even professionally, it's not just true only within the companies you build, but it's also true, for instance, with VCs. I had met Jeremy Levine at Bessemer when we were both at McKinsey. He was in the office next to mine at McKinsey. And then we reconnected randomly in the streets of New York in like '04. And it was a bit too late for Zingy. I mean, we ultimately didn't raise any VC money for Zingy, but then he backed to me at OLX. And so, and I don't think it's necessarily karma at a cosmic scale, but that if you're honest, open, positive, helpful, people have a tendency to be that for you. It really matters. On the deal making side, the types of deals, I guess the deals at OLX came in a number of categories. One is we build it partly through M&A. We acquired 13 different companies. And same thing, the idea that you can be super friendly and helpful in approaching potential acquirees. I mean, most of them, I just reach out to them on LinkedIn. I went to Alexa, I looked at what were the top classified sites around the world in different countries and different categories. Then I LinkedIn and emailed them and told them it'd be, I could be helpful and would be fun to work and build something together. And more often than not, people were up for it. And I think it bought 13 companies over the first few years to start scaling the company. So deal making on the way up. And then the exit is, I guess, a very large deal. And the lesson on the exit side, which I'm one I would recommend all entrepreneurs, is when the time comes to exit, do not do the negotiations, the exit yourself. Either hire a banker, which is what I did for Zingy, because then they can play the role of the bad cop and you can say, look, I really want to work with you, but my banker is saying this is not market, and I would be stupid if I accepted these terms. Can you work with me and get me and get somewhere along the way? Even though you may be the one driving the negotiation behind the scenes, you build a much better relationship with the potential acquirers on a go-forward basis. In the case of Zingy, I did it with an investment bank. In the case of OLX, frankly, Bessemer or BC played that role of the backup for us, and it worked really well. But definitely on the exit side, have someone manage the transaction for you.
Yeah, those are some great tips. On the relationship side, it's like the people you see on the way up are the same people you see on the way down. So always, have a good relationship no matter what happens. It's like the ripple effect. One relationship may lead to 10,000 down the road that you don't know about right now. So there's a lot of lessons in there, and I love that fact that you had this relationship with Alec before, years went by, and then you guys reconnected and built something incredibly powerful together. And then on the deal making side, I really love the fact that you do advise companies to use a banker, even though bankers sometimes get a bad rap for working with startups. They are a good buffer in between a potential buyer and yourselves.
Exactly. They may not even bring other buyers to the table. Often you may know all the potential buyers because you're in the industry and you've been operating, though usually actually they do. But maybe even if no one else bids, the very fact that they're there will help you negotiate much, much better terms. And that buffer is really important. It's totally worth the fee.
And I bet those in-mail responses you got from LinkedIn were much higher than they are today with all the spam coming through in-mail. And that was probably a novel way to connect with people on LinkedIn back then.
Yeah, I mean, a lot of the stuff we did back in the day was novel, right? We were doing long tail bidding and keywords on SEM, which no one else was doing. And so the CPCs were paying was like 1 cent. There were not even minimums on the CPCs relative to if you're buying used car, that's super expensive, and you're competing with Mercado Libre or eBay or whatever. And so a lot of we also still early in the SEO game. And so we were able to do SEO very successfully All these things are a lot harder, but not to say you can't scale business today. Quite the contrary. I think there are more opportunities today than I've ever seen ever before. And I'm sure we'll discuss that later.
Absolutely. So let's talk about your transition to venture capital. So in 2013, you started FJ Labs with your partner, Jose Marin, as a hybrid venture fund and a startup studio. The fund was formally born in January 2016 with a $50 million investment from a strategic LP, Telenor, along with your personal capital and the small entrepreneurs fund you run on AngelList. Your second fund is expected to close with about 175 million of external capital. And as of April 30th this year, you've invested 284 million, of which 114 million was provided by Jose and yourself in 571 startups. You've had 193 exits with a 62% realized IRR and have started 13 companies. Of all those things, what's your proudest accomplishment since starting FJ Labs?
You know, the funny thing is I didn't become I never aspired to be a venture capitalist, nor did I ever aspire to become an angel investor. I think it just happens naturally by virtue of being consumer-facing internet CEO that's reasonably public. A lot of people start asking for advice and money. And so I started angel investing at the very beginning, like the same moment I created Aucland when I started angel investing. So by 2013, when I exited OLX, I already had over 100 investments and was growing really well. And I was like, okay, I like building companies. I like starting companies. I like investing in companies. Maybe I can create a structure that allows me to do both. I guess the proudest accomplishment was actually succeeding in finding a way to serve or to address both of my underlying desires, to be helpful to the community, to be an investor in hundreds of startups, and to scratch that entrepreneurial itch by building one or two new companies every year in the startup space. And FJ Labs is very much a startup, right? I didn't join a venture fund. I actually decided to start one from scratch, which is itself requires fundraising, building all the different structure, et cetera. It's basically successfully actually setting out and building a new startup in a way from scratch at a very unique approach. I mean, it's not at all the traditional venture fund where you write concentrated bets and a few large bets and a few companies, you're on the board, et cetera. And typically you're not both building companies and investing, but able to do something that felt right for me.
It's funny because you didn't set out to build a venture fund or an investment fund, but you're more well known as an investor than you are as an entrepreneur, even though you started so many successful companies. And I know that wasn't the intention, it just happened that way.
Yeah, I mean, the time where it was the funniest is when I was running OLX. I mean, OLX is 5,000 employees, 30 countries, 350 million uniques a month. It's like one of the largest sites in the world. It's part of the fabric of society in so many countries, from Russia to Ukraine, all of Eastern Europe, Brazil, India, Pakistan, the Middle East. I mean, it's so huge. And yet most people think of me as an angel investor. And the reason is that I guess I'd never bothered to hire a publicist or try to fix it. Is just if you looked at TechCrunch or in the press, my name would be associated with the hundreds of startups that I was investing in, and only once in a while the OLX that I was actually running, even though I was running that. And so if your name is associated with hundreds of companies as an investor, that's what bubbled up. But if you look at my time allocation from 98 to 2013, it was 95% running the company I was CEO of, not investing. And yet I was known as an investor, which is really funny. But it doesn't matter. Like, the world can see me the way it wants. At the end of the day, what matters is the personal satisfaction I get of the life I lead and the impact I think I have.
Yeah, absolutely. And you've had a tremendous impact investing in over 570 startups. So we're going to talk about your entrepreneurial and your investing experience to think about how to invest in marketplaces before it's a marketplace. So first off, I'd love to hear how you define online marketplaces and what are the largest advantages and disadvantages online marketplaces face today.
So a marketplace is an intermediary between a buyer and a seller, and that's at the very basic level. And as a result of that, so you're a market maker, creating a market for something that may or may not have existed before. So that's just very basic definition. Now, advantages of building one today in 2020 is that in a way, we benefit from all the marketplaces that have come before. So we have these smartphones that have like GPS devices. We have massive potential markets. We have companies that help you outsource all of the fundamental elements of the business you don't want to be doing. So you can be focusing on whatever part of the value chain is the most useful. So if you want to be helping people sell a widget, you can actually partner with others for doing the delivery and the logistics and 3PLs, et cetera. So customer acquisition channels are reasonably well established today. I mean, they're and few that are like set by default that seem to work for most people. If you can make the economics work, right? Facebook and Google on the one end, and online, you can have sales team if it's B2B, and maybe TV ads are larger, and a few can even have can even TV if they're mass market and the scale for it. Other fundamental advantage is you can actually see the trends that are happening in various verticals and various marketplaces, and you can reinvent them. So for the longest time, marketplaces in a way were rather basic and rather horizontal. So you had a Craigslist, which is a marketplace, a intermediary between buyers and sellers of goods or services, and you would say, oh, I need X, and hundreds of people would apply. And so the amount of work you would need to do to actually filter through your suppliers was outstanding. And today, the new marketplaces, they just pick the supplier for you and increase the user experience, increase the NPS, increase the fill rate. You can basically have 100% success rate in transactions. I mean, many of the marketplaces today appear to be the provider of the service, even though they're marketplaces. So think of an Uber. You don't pick your driver, Uber picks the driver for you. And this is a trend we're seeing across like all the services marketplaces. If finding a programmer, instead of going to Upwork, selecting amongst 200 or 300 that apply, the marketplace will pick one for you, or a photographer, or a transcriber, or whatever it is it may be. So it's frankly easier than ever before to build a marketplace. It's easier to scale it than ever before, and you can stand on the shoulders of the people that have come before. And yet, a lot remains to be done. There, in B2B, very little has actually been transactionalized, in the horizontals are continuing to be disrupted, and we're still at the very beginning of that trend. And in each of the core verticals, from food to real estate to jobs to lending, there's massive innovation happening today. So we're still day one in the marketplace world, and it's better and easier to build than ever before.
Absolutely. And it's obviously become more capital efficient. The data points are getting more and more robust, and marketplaces are becoming smarter. But I think the problem that we're still trying to solve at the early stage, which I'd love to get your insight on, is how do you know which side to start on? In some marketplaces, the suppliers are relatively easy to find. In others, it can be painfully slow and requires a lot of touch points. Given the challenges, how should a company think or know which side of the marketplace to start on?
99% of marketplaces are demand constrained, not supply constrained. Because if you go to a supplier, whether it's of a product or of a service, and you tell them, "Hey, I may have customers for you. I don't have many or any right now, but it's possible, and I'll just take a commission if they succeed." Almost all of them are willing to give it a try. And so, actually, it's always easy to get the supply. And in fact, one of the biggest mistakes people make is they just try to get all the supply. And then you flood your marketplace where you have infinite supply, but you never bring them any customers, or most of them, you don't bring them customers. And so they churn, they're not responsive, etc. So my fundamental recommendation is you start the supply, but you get the very best supply, highly curated, that's going to provide the best experience, that understands and is committed to your platform. Then you get them demand. A good metrics of you don't necessarily want to overgeneralize, but if you're selling a used good, you want the propensity of that good to be sold, if it's placed on sale, to be about 25%. If you're selling a service, you would like to represent maybe 25% of the annual revenues of that service provider. This way, they're going to be engaged and not going to churn. I mean, ultimately, you want to represent 100%, but early days of like proving liquidity. And once you have that, you go back and build the supply again. And usually, and it depends on the marketplaces, but especially the hyper-local ones, density matters, and you're more likely to have network effects once you start having density. And so you got a few people, you got one person in a zip code, then a few in that zip code, then you go to the conjoined zip code, and then you expand from there. Always match. So start the supply, but then match the demand of the supply, and then add more supply, and so on and so forth. The biggest mistake people make is they just flood the market with supply because they can, but it actually leads to a failure because they're not matching effectively, and they're not creating enough liquidity.
Yeah, sometimes I notice that there's like so many suppliers listed on a marketplace website, and I ask them, how's it going? How'd you get all these? A lot of the times they just scrape the yellow pages and Google and take the company's names and throw it on a supplier, collect any interest coming from the demand side, and then go to that supplier and say, "Hey, by the way, you've been on my website for 3 months now, and I found a bunch of buyers that are interested. Do you want to be a supplier on our marketplace?" Probably not the best way to build relationships with some of the best suppliers out there. Now, interesting. How did you kind of come up with the 25% utilization?
It's when we start seeing liquidity from an observational perspective. Is like, when do people start feeling satisfaction being in the marketplace? And by the way, the very best marketplaces are like 60, 70%. on both propensity to sell. So if you place an item for sale on an OLX today in the for sale category in the countries where we're large, it's probably a 60% probability of selling it, a used unique item. And if you're a service provider on an Uber, etc., many people probably make 100% of their income from Uber if they're full-time drivers, or at least if they're supplemental income. And perhaps it's 60-30 or 10 or 70-30 with Lyft, but that's the type of dynamics you end up with. So I think it's just through observation more than anything else that it seemed to be that magic number at which people started being really engaged, and both sides of the marketplace started being very satisfied.
That's a perfect segue into the next question, which you kind of answered here. The most common marketplaces that come to mind are the ones that we use regularly. How important is the frequency in building a successful marketplace? So you say with the Ubers and Lyfts, it's 70, 80, 90%. Let's say it's a startup, though, who's still figuring out if they can even get to that 25% before they add on new suppliers. What do you think that thought process should be for an early stage startup?
Frequency of transaction helps because it helps with unit economics. But at the end of the day, I care only about the unit economics. And there are two ways you can make the unit economics work. You can either have high average order value, and that's true in real estate or in car marketplaces where people are not transacting very often, or you can have them by transacting on a regular basis, and that would be more the Ubers of the world or the Poshmarks of the world, where people are using the service multiple times a month. But at the end of the day, for me, good unit economics is one where you recoup your fully loaded customer acquisition costs on a net contribution margin basis after 6 months, where over the first 18 months, you 3x your CAC. And ideally, you don't know what your LTV to CAC is because you have negative churn. So even though you may have lost half the customers, the remaining half are buying more and more and more. And so maybe your LTV to CAC is 5-1, 10-1, 21. Now, if you're pre-launch, I still expect you to have thought about these things. So if you're a pre-launch marketplace, I expect you to say, well, in this category in the world, the average order value is this much. And we know the margin structure on the products we're selling and the take rate we have, and therefore we expect our net revenues to be this amount and our contribution margin to be this. And by the way, we think that our customer acquisition channel is going to be whatever. We did landing page analysis on Google and Facebook, and we paid $1 a click. We had 10% sign up, so that was $10 per sign up. We think 10% of these will buy. It'll be 1% conversion rate overall from a click. That'll be $100 CAC, and we can make the economics work. So, and by the way, making the economics work is not enough. I want you to also have done enough of homework to show me that there's density and depth in your customer acquisition channel, that there's enough keywords on Google or Facebook, that your sales team is scalable enough, you have enough demand side that you can actually build a large business with that channel, whatever it may be. Again, and if the economics are not there, you need to have a compelling story as to why they will get there just with scale, not requiring every star in the multiverse to align.
That definitely seems like a lot more than companies are probably doing at the early stage. So I'm glad to hear you share that with them, because they should really understand their unit economics. Bill Gurley once said, not all marketplaces are created equal. And great marketplaces don't need to simply aggregate markets, but they need to enhance them, as we've seen with Uber, OpenTable, and many others. How do you think startups should think about enhancing a marketplace today with so many existing marketplaces already being enhanced?
Think of what the user experience is like and what the NPS is like. And the marketplaces I like the best today are the ones where you take an experience where usually the demand side is doing a fair amount of work, selecting the supplier, et cetera, and the marketplace does it for them. And so it's definitely true in all the services marketplaces. Right now we're investors in Advisable. It's a marketplace to find marketing talent, or investors in Comet, a marketplace to find programmers, or investors and or think of Rev, right? Rev, you don't pick your transcriber. Rev picks it for you. Where in Miro, which is a photographer marketplace, Miro picks the photographer for you. And so these marketplaces where they do the curation, so not just the aggregation and the matching, because if that's all you do, it's rather easy to replicate. It's also easy to be disintermediated where the user is not wanting to pay your rake, but actually be fundamentally embedded in the experience of the marketplace. And there are not a lot of ways you can do that, by the way. One way to do that is by picking the supplier, which is one way to discuss, and being highly curated. Another way to do that is, I think, something we're going to discuss in the next slide, is providing free SaaS tools to one side of the marketplace or the other. Let me give you an example in the food space. We're investors in a company called Slice. Slice is a pizza food delivery application. And most people, when I invested, were like, wait a minute, why would that ever make sense? I can order pizza on Seamless Grubhub and I can order pizza on Uber Eats. Why would I need a pizza delivery app? And the thing is, they didn't put themselves in the shoes of Luigi, the owner of the pizzeria. So the pizza market is about 43 billion. 66% is controlled by the long-tail pizzerias, the Luigi's of the world who have only one pizzeria, and 33%, of course, is Domino's, Pizza Hut, and Papa John's. Now, these long-tail pizzerias, half of them didn't have a website, most of them didn't have online ordering, and think of what Luigi wants to do. He wants to cook pizza. He wants to chit-chat with his customers. What does he not want to do? Pick up the phone, create a website, answer comments at Yelp and TripAdvisor, do packaging, negotiate, select a POS system, do his accounting, etc. Right? He came into this because he loves making pizza, not because he likes to do everything else. And so what Slice did is they said, look, we'll do all of this for you, and in exchange, we'll take 10% of the transaction fee. And that company grew to hundreds of millions of orders by really funnily helping one of the marketplaces. And what's part of the reason this is really differentiated is you can imagine that Seamless Grubhub is never going to do that. So the same way in the vertical product space, TCG Player is an online Magic the Gathering marketplace to buy and sell cards, and they're also in Pokemon. And the way they got started is the founder owned a comic book store, and he realized that the existing POS systems didn't manage all the millions of SKUs that existed in Magic the Gathering. So he built this. And after he built it, he's like, maybe I should sell it to other comic book stores. But he realized that's a rather small market. If 10,000 of them pay him $10 a month, it's not a very large business. Instead, he said, you know what? Here's the tool for free. Manage your inventory on it. And by the way, if you want, you can sell it on my platform. And if it sells, and may or may not sell, I'll take 10%. And now they're doing over 100 million in sales a year using a very differentiated approach. And you can imagine eBay is never going to build a Magic the Gathering inventory management software for the back office of comic book stores. And so having these approaches where you're really deeply embedded on one side or the other side of the marketplace. If I recall correctly, RigUp, which is a labor marketplace for the oil services industry, they started by building contingent labor workforce management tools, which they gave away for free to the oil services companies in the world. Think of Mira, the photography marketplace I mentioned earlier. Photographer wants to take photos, doesn't want to be doing invoicing, customer acquisition, discovery, post-processing, editing, retouching, etc. And so they do all that on behalf of the photographers, so the photographer can do the job they love to do. And so it kind of crosses into my vision of the future of work, which is the workers will do only the job they would love doing, and everything else will be done for them. And so if you do that part of the market of the business, you're going to be in an amazing position to innovate and to lock in your supplier, lock in your demands.
It also reminds me of a co-investment portfolio company we share, Tread, where they started helping out the small mom and pop dump truck, construction players in the space who have a very fragmented market, who don't want to deal with invoicing, paperwork, delivery, tracking, all that kind of stuff. They just want to pick up dirt and take it somewhere else. But it's a massive market, 3 times the size of the North American taxi industry. And they're helping enhance a marketplace that exists, but where nobody really wants to focus on those things that you just mentioned that Slice is focusing on. It's kind of like how Shopify got started too.
Yeah, absolutely.
They just realized the market was, $600 billion bigger than it really was just for snowboards. But anyways, this is what I think we really want to get your thoughts on. So given the competition in marketplaces now, and that marketplaces are starting to become more of a workflow for people to enhance their overall experiences for all the parties involved, facilitating workflow reduces the work for the participants as well as increasing switching costs. So how should new marketplaces think of becoming a SaaS tool early on to enhance that stickiness, whether giving it away for free or a small fee?
Yeah, I would do an analysis, by the way, in terms of whether you should charge for it or give it away for free in terms of utilization. If you give it away for free, of course, usually it's easier to convince people to try it, but sometimes they don't pay for it, they don't value it, and therefore they don't use it. So that would be an easy A/B test on where the right approach is. Also, it may very well be that in some B2B marketplaces, you cannot monetize the transactions because people are too price sensitive. And so there are a number of categories where the transactions are commoditized to the point that even a 0.1% rate would not work, and people would bring the liquidity elsewhere, in which case perhaps the business model is to be a B2B SaaS provider. And by the way, when I say B2B SaaS tools, it need not be you're building an entire tool to manage the back office operations of one side or the other. It could also be a suite of tools that people prefer to use or independently useful, and that people use on an ad hoc basis, often way easier to build. But if you become the place where they figure out what these salaries are in the category, well, if you're also providing labor, maybe that's a place where they'll just, let's see who's available in that marketplace and hire the person there, for instance. And so but absolutely, the providing SaaS tools to one side or the other of the marketplace is one of the approaches that is the most successful today, especially in B2B marketplaces, where we come to realize that many of these old categories and industries, everything is still done on Rolodex or email or Excel or pen and paper, as opposed to actually being online. And so bringing the best practices that of the consumer world and the lives we have to the B2B world makes a lot of sense. And the why now for this, by the way, is as the original CEOs of the larger companies, or are in like their 60s or 70s, or not tech literate, or being replaced by and the same thing with the owners of like the SMBs that are being replaced by like younger millennials who are tech native, digital natives. They expect to see all the same type of tools they have in their consumer lives on the business side. And so it's absolutely a wedge to use, and many of our companies are using them, whether or not they monetize it. I mean, we talked about Slice, which of course is not monetizing providing the tools, it's monetizing transactions, but in a way, it's a means for them to have a customer acquisition cost of zero. A few other examples. I mean, we're investors in a company called Fresha. Fresha basically realized that MindBody, which is a marketplace to make reservations for barbershops or hairdressers, etc., their customers hated paying them because they felt they were charging, or they were paying for their own existing customers, and they didn't want to be monetized for their own existing customers. So Fresha went in and said, look, we will provide you a cloud-based, much more modern tool for free. We will never monetize the transaction. We're never going to take a listing fee or a booking fee. We'll take a booking fee if we bring you a new customer, but your own customers will never monetize. They signed up like 40,000 like barbershops, hair salons, spas, etc. They got like 4 billion in GMV going through the platform, and then they went and said, okay, Adyen, Square, Stripe, all these payment platforms, I have 4 billion of GMV I can bring to you. What's the very best deal you can give me? And they negotiated the most discounted payment terms ever. They then went back to the merchants and said, hey, let me do your POS for you. You're probably paying 3. I can give it to you for, I don't know, making the numbers up, 2.6, while their cost is 2. And so it's win-win-win. Like I don't know who they ended up signing with, but one of the payment companies got a massive amount of view volume. The merchants got lower fees they would otherwise pay, and the company found an amazing business model indirectly. And all that came from providing, in a way, a free tool to manage the back office operations of your barbershop in a very successful way. And so absolutely the main wedge I think we're seeing today in terms of how people are building marketplaces.
That's brilliant. I mean, it sounds like they basically created a cooperative with all of the barbershops not really knowing it and helping them speak with a louder voice. And like you said, it was a win-win-win. And the barbershop's like, all right, well, they're not my enemy anymore. These people are helping me on my own cost savings, which is absolutely brilliant. But I also think SaaS tools are now table stakes for marketplaces. And if you don't have a SaaS tool, it's going to be really hard to know your customers, because you're not going to be able to get the feature requests from them on things that they use every day. And the stickiness is just, you can go from one place to another. But I love that idea of getting around people blocking you from getting their customers by saying, look, we'll help you use our tool for free with your existing customers that we won't charge you for. And if we do bring you value, then you pay for it. I mean, that's absolutely perfect. When I get a haircut and I choose not to pay on the website, I don't think my barber's still getting charged for me to put my email address in to get a haircut. At least he shouldn't be, because that's not the right thing to do. But it makes the customer feel like it's a good experience by able to book online and then show up that day for my appointment.
And by the way, the SaaS tools are not the end all be all, right? Like, if an industry is already pretty well penetrated, everyone has a POS, everyone has their own tools they're happy with. Don't just go build a SaaS tool, even if it's free, versus the incumbents. I mean, really think through what is it they need that they don't have or they're not using, where you can provide value, and that also be connected to your marketplace in some logical way. So it's not just, oh, everyone's doing it, let's build a SaaS tool, right? It has to be very well thought through.
Yeah, absolutely. I mean, this perfectly transitions into the payment side of things. So with all things being equal, being a part of the payment flow is superior to not being part of the payment flow. And this is due to the fact that it is much easier to extract reasonable economics, as you mentioned with the Stripe deal, when you are in the flow of the payment. And with the rise of fintech APIs, how should marketplaces think about owning their own payment infrastructure or still relying on Stripe as they grow?
Well, so first of all, I fundamentally agree. Being in the payment flow is way better. And it's way better not just because perhaps it gives you the opportunity to take a break. It's actually better because it's a better user experience, right? Like everything is done online. We know the transactions are happening. We can help you with the customer service if anything breaks, and you create this end-to-end experience. So it's better in general. It's not just, oh, now we're in the payment flow, we can take a percentage of the transaction. No one builds their own payment infrastructure, to be honest. Like, there are amazing companies out there like Rapid or Unipass that are focusing on helping marketplaces transact that can be built on top of the Stripes, et cetera, of the world. So I think it's totally fine to be using third parties the same way that when you're building your company, you're using Jira or using Asana, or you have Slack. You have a set of tools that are common that people use to build the companies. And so I don't expect people to go and build their own payment infrastructure when there's others that are plug and play that are there. Especially if you implement it right, and you appear to be the payment provider. It doesn't say Stripe. It says, your company.
Yeah, but it sounds like companies are able to still benefit from aggregating that payment flow and then having a better negotiation platform to stand on when they're going after. Because I know with our portfolio companies at the early days, I mean, they're definitely paying a higher fee for the volume
absolutely.
that they're bringing, but aggregating that is one way to defend yourself.
Yeah, but I'm not saying build your own. Yeah, yeah. But in a way, you're aggregating it, right? Like, even though you're using Stripe, if I guarantee you, if you're bringing 500 million of volume through the platform, you're going to be able to negotiate better fees, because you can say, look, I could easily switch you out and switch someone else. Square will bid for this, and Adyen will bid for this in a heartbeat. So they are going through you because you're the volume provider. So I wouldn't worry about needing to have everything into it in your back end. Yeah, so I'd still use all these guys, and of course you'll negotiate volume discounts.
Yeah, and I think the value will still be translated into your own company. We talked with Reed Christensen at CRV the other day, and he said that his companies who are at the front-facing part of the platform, who are not owning the payment rails, are still seeing increase in value because they are collecting and aggregating all that payment, and investors are giving them value for it, even though there might be not generating fees directly from it. So I think it's important for you to own it.
Absolutely.
That's awesome. Well, you have some great book recommendations, Fabrice, here, and I'd love if you can explain to us each one of them and why our audience should give them a read.
First of all, I'm a voracious reader. I read 100 books a year. And by this, I don't mean just nonfiction. It's probably 70% fiction, right? It's like sci-fi, fantasy, etc. And so I was thinking through, are there entrepreneurial books that I think are amazing? And frankly, the answer is no. I don't actually read business books that are like how to build a business, how to be building better relationships, etc. I think these are mostly boring. They feel, frankly, very generic. And so I was thinking through, what are the 3 books that I've read recently that I thought were the most useful and compelling, other than things like Sapiens, which is like, kind of philosophy. And the 3 I really like were Loot Shots by Stephanie Bacall, which is how does one maintain the ability in an organization to nurture both a scalable, sustainable engine of profits, and while also having these kind of innovation labs where you keep having innovation. Because what we see often in the larger companies is once they find something that works, a franchise, as Safi calls it in Loot Shots, they keep doing that over and over again, and they no longer have innovation. Think of it in the Hollywood world. in actual sequels, right? Like there's very little new IP that is coming out. Or if you're Apple, the franchise would be the iPhone. And what's the new IP? There's no like real new fundamental innovation. So the larger companies, especially, once you have a franchise, have a hard time being innovative. So this is how do you keep nurturing and being in a position to have both. And it also gives us counterexamples of companies that are built purely on repeated innovation that ultimately never build this franchise and peter out as a result. And so I thought it was really interesting, especially as the companies scale, as you try to think through how to be both respectful and give the same amount of love to your accountants who are running the franchises and to your like genius creative types that are running the loon shots and the innovation factories. And some people have it for a while and then it fails, right? Like if you think of Bell Labs that had the loon shots, but they were never able to transcribe it and transform it in franchises, and they were actually ultimately captured by the Bill Gates and Steve Jobs of the world, as opposed to within the organization. Why we sleep, I love, because as a founder, especially as a young founder, when I was 23, I was like working 110 hours a week. I'd go to bed at 1, I'd get up at 4. I was working 7 days a week. I didn't sleep at all. And I was overcompensating my lack of experience with overwork. And Matthew Walker really shows why that actually is detrimental to your judgment, frankly, to your quality of life for sure, but also to your health, to your decision making, and to your ability to be effective. And it's really about the power of sleep, and it breaks down the difference between REM sleep and deep sleep, how much you need sleep, et cetera. Now, some of the science of the book, I think he's exaggerated the claims, but it's extremely powerful. And it kind of led me to the next book, which is Lifespan, which is a book by David St. Clair, which is on why we age and how we can slow down our aging and also lead extremely healthy lives. And I think as entrepreneurs, we have a tendency to be biohackers of like, how can we be more productive? How can we make better decisions? And so in this case, and it actually repeats a lot of what Matthew Walker said on the sleep front and how important sleep is. And there are a whole bunch of hacks you can do for better sleep, but it also goes into diet, fasting, intermittent fasting, and all the different things you can do to improve your quality of life. So I think all three will make you a better entrepreneur, a better founder, and a better person to scale, and will frankly improve your quality of life. And that's why I put those 3 books over others. But frankly, I love reading, and I think reading is one of the great joys and pleasures to have in life, and is worth doing, except idiotic business books. I think those are mostly not worth the paper they're written on.
Couldn't agree more. These are 3 great book suggestions. I noticed that there wasn't any books on how to fly 50 feet in the air and come back to Earth safely.
You mean kite surfing? I also like pull massive air heli skiing. So I love books like Into Thin Air, which are by John Krakauer, and these types of books. I've actually often wondered whether my risk tolerance and my love of risk in general is what led me to become an entrepreneur, or if being an entrepreneur also helped with that and made me more appreciative. But I think the answer may actually lie elsewhere. I think it's, and I meditate, and in fact, meditation is one of the recommendations. So I find that when you can enter a flow state in that Zen-like space, you're highly, you feel really alive. And I find that one of the best ways to do that actually is to be playing an intense game of tennis, to be kite surfing, to be extreme skiing. And yes, it's a different form of meditation. It's an active meditation rather than one where you're just purely focusing on your breathing or trying to clear your mind. But I find it extraordinarily useful and a way to like reset my mind, focus on the present where nothing else matters. And if your life is on the line, like your car racing and you're at the verge of losing control, I think it's those moments where you feel more alive than you've ever had.
Couldn't agree more. I mean, the first time I learned how to kiteboard in Cape Hatteras, my mind was clear, but I was so scared and focused at the same time not to die. And then heli skiing in Galena in Canada as well was probably the most unbelievable experience I ever had. So before we wrap things up, I always ask our guests for any final words of inspiration for our audience.
Whatever you think you can, begin it. Boldness is magic and genius to it.
That is amazing. Very short and sweet. I absolutely love it. Thank you so much for joining us in the tank today, Fabrice, and sharing your entrepreneurial and investing journey and your thoughts on investing in marketplaces before they're a marketplace.
Thank you for having me.